Hi everyone, welcome to the session. In this video I am going to show you how to calculate net present value and IRR by using Excel formulas. So you need to calculate the net present value. You are given set of information, and based on this information you need to calculate the net present value as well as IRR, internal rate of return. So you are given the year-wise cash flows. Then based on this you need to calculate the present value. You are given from year 0 to year 5, and the cash flows also given. So by using the discount factor 9%, we need to identify the net present value and IRR, and NPV is calculated by taking the sum of the present value of all the cash flows. To calculate the present value, we need the discount factor. So when you apply the discount factor on the cash flows, you can identify the present value. So if you take the year 0, the year 0 discount factor will be 1 because it is a current value. So we don't discount it. So straight away we have to take 450,000 as our cash outflow. So that is a present value. And year 1, we need to identify the discount factor, which is 1 divided by 1 plus the discount factor, which is the 9%. 9% to the power year 1, that will be the power. So we have to take year 1, so that will be the discount factor. Let's make it to 3 decimals. We'll make it to 3 decimals. Yes. So what we can do is we need to drag it down until year 5. So we need to fix the discount rate. So to fix, we need to press F4 so that it will be fixed. It will remain the same, the discounting factor, so that you can easily drag it down. So automatically the discounting factor will be calculated for the remaining periods. Now, so what you need to do is to calculate present value, you take the cash flow times the discount factor, so that will give you the present value 450,000. Just drag it down, so it will copy the formula automatically from year 1 to year 5. So that will be the present value for each and every year. Now we have identified the present value. Now we need to calculate the net present value. So net present value is nothing but it is the sum of all these present values. Just add them together to get the net present value, which is 53,459, which is a positive figure. Positive means the project is feasible, so we can accept the project which is feasible. So this is the NPV. Now by using the NPV formula, we can calculate the present value, net present value. So simply open the bracket. So when you open the bracket, you need to select the rate first. Rate times the cash flows from year 0 to year 5. So that will be how much? So that will give you 49,045. So which is totally different from the usual calculation. Our normal calculation, if you apply the normal way of calculating the NPV, which is 53,459, whereas the rate, if you apply the formula, which is different. Because why there is a difference? The NPV takes into account the year 0 as well. So therefore what you need to do is you need to separate the year 0 cash flow, which should not be discounted, which is the present value, plus apply the NPV for the remaining cash flows. Take the rate 9%, then year 1 to year 5 should be considered here. Then Based on this, we can see, so we are deriving the same figure as our normal calculation, 53,459. So which is the net present value. So this way of calculating is not correct. It is incorrect because the calculation is there is some mistake in the formula. So therefore we can't straight away use the NPV formula in the Excel calculation. So we need to make some adjustments to that. How do you make the adjustment? You need to make the cash flow year 0, you need to add it first, then only you need to apply the NPV formula, because year 0 you can't discount it. So this formula discounts the year 0 as well. Now at 9% discount rate, the NPV is 53,459. Supposing if you change it to 10%, the NPV will change. It's decreasing. So it will decrease. If you apply 15%, it's a negative 27,487. 27,487. So as you can see, when you change the discount factor, the NPV will decrease. It's changing. So therefore we need to identify the rate at which NPV will be neither positive nor negative. So this is known as internal rate of return. So IRR is calculated by taking the cash flows from year 0 to year 5. So that will be 13%. So 13%, which means if you take the exact figure, which will be 12.784. So when you take this 12.784 and if you apply it on the discount rate, just copy and paste it on the discounting rate. So what will happen? You can see that NPV will be 0. So your NPV will be 0. So which means neither positive nor negative. So this is known as internal rate of return or IRR, at which your NPV will be 0. So this is how you calculate the NPV. So if the IRR is higher than this is also known as cost of capital. If the IRR is higher than the cost of capital, which is a good project, which is a viable project, so you can accept the project. So if not, the project will not be a viable project. So with this, I will conclude the session. I hope you found this useful. So thanks for watching, and if you like the video, please subscribe to my channel to watch more videos. I will see you soon with another video. Until then, bye for now.